Hello, everyone. My name's Chris, and welcome to the webinar on retirement pathways presented to you by the Financial Information Service at Services Australia. My colleague, John, and I will be your hosts today. Before we get started, I'd like to acknowledge the traditional custodians of the lands we all live on today and extend Services Australia's respects to all elders past and present of all Aboriginal and Torres Strait Islander nations. I'm speaking to you from the traditional country of the Gubbi Gubbi people in southeast Queensland. For those of you attending our webinar as a live event, there is a question and answer feature you can access to ask questions while the webinar is in progress. You can access this by clicking on the icon that looks like a speech bubble with a question mark in it near the top right-hand side of your screen. And in the interest of protecting your privacy, please use your first name only or tick the box to send your question anonymously. If our team of moderators think your question would be useful for others to see, we may publish it for all. Otherwise, we'll reply just to you. And for those watching on YouTube after the event, you can find the links shared during the live event in the webinar summary section. Some of the topics that we will cover today include planning for your retirement years, superannuation, accessing superannuation, working beyond age pension, and the work bonus. We hope you will go away with the knowledge that can help you make financial decisions and navigate through the system with ease. As always, you can call our Financial Information Services if you wish to discuss your own circumstances. Financial Information Service officers like John and myself can help you build your financial literacy, help you make informed financial decisions, and help with your financial needs. As an information service, we don't provide financial or planning advice. Advice is telling people what to do with their money and how and when to do it. We don't do that, but what we can do is provide free, confidential information to help you understand your financial options and empower you to take charge of your finances and feel confident in making your own choices. The information in this webinar is correct as of today's date, being the 6th of November 2024. However, please refer to our website for further information, as our payment rates and thresholds will change in the future. For those of you watching the recorded webinar, please ensure that you visit our website for current information. Now, when planning for retirement, you are planning for the lifestyle you want in retirement, not just to receive the age pension. Everyone's retirement lifestyle will be different. You might have plans to pay off the mortgage or downsize your property, or take that long awaited trip to Europe, or you might want to update your car or renovate your home. Whatever your plans might be, you need to be realistic about the lifestyle you want and take steps to plan for this. So, do you want to live comfortably, or are you happy with a modest lifestyle or a combination of the two? Consider your financial position as well and what you will need to maintain your financial comfort. Do you have enough money to fund your retirement plan for the next 20 to 30 years? When retiring, you should aim to be debt-free, have a healthy cash reserve, and have enough income or capital to meet your long-term needs. Now, depending on the lifestyle you want, the amount of cash reserves, income or capital will be influenced by a number of factors. So firstly, are you single or a couple? What age are you when you retire? Do you have expenses or a mortgage or other debts? Do you need to replace or upgrade some of your items like a car or kitchen? Do you have the ability to access equity in your home if ever you need it? What's your health like? And more importantly, what lifestyle choice do you want? If you are not sure about the savings you will need at retirement, the Association of Superannuation Funds of Australia, or ASFA, provides an indication which is dependent on whether you want a modest or comfortable lifestyle. So the following table shows a lifestyle comparison between ASFA's retirement standards. It applies to people retiring at age 65 who will live to an average life expectancy of about 85, and it assumes that they own their own home. So, a modest lifestyle is where retirees just need the basics of life. So, this lifestyle is a person who is happy spending the rest of their life in the garden, watching television, reading library books, eating home cooked meals, and will only need the age pension plus a small amount of savings to maintain their home. The amount of savings required to support a modest lifestyle for a single or couple is approximately $100,000. Now, what's interesting to note is that the Australian Council of Social Services describes ASFA's modest lifestyle as living just above the poverty line. A comfortable lifestyle is where retirees are involved in a range of leisure activities and have a good standard of living. So they've got their private health insurance, a reasonable car, household goods, and they travel regularly. These retirees will need a higher amount of savings in retirement, and ASFA estimates that the lump sum required at retirement to support homeowners is about 690,000 for the couple and 595,000 for a single person. It also assumes that they are paid a partial pension and have a diversified investment portfolio. However, even with 60% of your retirement savings invested in growth investments, you need to be aware that there is a risk of running out of funds in your lifetime. If ASFA's estimates don't work for you, a rule of thumb for estimating your retirement income is to assume you will need two-thirds or 67% of your pre-retirement income to maintain the same standard of living in retirement. You need to think about how much your retirement lifestyle will cost you and then work backwards to see what you need as a lump sum in retirement to fund that. To ensure that retirement income policy is sustainable in the context of an ageing society, Australia has, for the last 2 decades, pursued a three-pillar approach to the provision of retirement incomes. So, Pillar 1 is the compulsory superannuation contributions made by your employer, better known as the superannuation guarantee, and this currently sits at 11.5%, and it is due to increase to 12% from the 1st of July 2025. Pillar 2 is your voluntary savings in or outside your superannuation and is supported by taxation concessions and direct government payments for low income earners. And finally, Pillar 3 is the income and assets or the means tested age pension, which is a safety net to ensure that no Australian is without income in their retirement. Now, Australia's pension system is different to most other countries. In many countries, a person contributes to a state run pension scheme, so the pension in retirement is based on what you contribute. The Australian age pension, however, is based on income and assets and not on contributions over your working life. In Australia, retirement income is funded through a mix of personal savings, a government pension if you're eligible, and through your superannuation or super. Your super is made up of employer contributions, your own personal contributions, and sometimes additional government contributions if you're eligible. These contributions are invested by the super fund's trustee, whose aim is to grow your account balance while you are still working. When you've reached retirement age and stop working, your super is usually converted to a pension and you have full control over it in retirement. So a question to you is, what is superannuation? Superannuation or super is money that's put aside and saved while you are working. Your employer will make regular payments into your fund so you can have a future pension or a regular income when you retire. Superannuation is taxed under a more favourable regime than the marginal tax rates. And if you are under 67 years of age and your superannuation is in the accumulation phase, that balance or your balance is an exempt asset for Social Security assessment. However, the trade-off is that your superannuation cannot be accessed until certain conditions are met. Now, most people will work for 30 to 40 years and then live for another 25 to 30 years after retiring. A question you will need to ask yourself is, do I want my income stream or my super fund to keep pace with the inflation during this time? If you answered yes, then you will need to check and see whether your investment option is right for you, as this could affect how your investment performs. It's easy to set and forget. We all do it. So, a good strategy is to regularly check how your super fund is performing and what they offer when compared to other super funds in the market. When you start employment, if you have not instructed your employer, you are defaulted to an investment option not of your choosing. The good news is that most super funds will allow you to choose from a range of investment options, which can be completed online. Therefore, you can switch to either a conservative option, which has less risk, or to a growth option, which has greater risk. Your risk aversion will help you to identify the right investment option for you. You can find out about your fund's investment options by checking its website or product disclosure statement. So, the product disclosure statement, or PDS, is a document that financial service providers must provide to you when they recommend or offer a financial product. It must include information about the product's key features, fees, commissions, benefits, risks, and the complaints handling procedures. So there are four main asset classes and each with varying returns and volatility. Your defensive assets include saving accounts, term deposits, and fixed interest investments like bonds. Growth assets include property, shares, and managed funds, and they tend to be more volatile. So for this reason, it's best that you review their performance once or twice a year. To lower your portfolio's risk, you can diversify across the different options within each asset class. So if one business or sector fails or performs badly, you won't lose all your money, as a variety of investments with different risks will balance out the overall risk of a portfolio. So, for example, if you buy shares, you could buy across a range of different sectors such as financials, resources, healthcare, or energy. You could also diversify by investing your money across different fund managers and product issuers. Now, when looking at it in the investment side of things, your decisions can be influenced by your age or life stage, what you are saving for. So, is it a first car? Is it a first home? Is it holidays? Or is it the retirement itself? Your past experience with investing will also influence your decision, and your understanding of the different investments and investment options will also influence the decision. So, when investing, remember, be realistic. Any investment you choose will have some form of risk. As discussed earlier, you need to identify your risk tolerance or your aversion to risk. So, what this means is that you are ready to accept that there is a degree of uncertainty you are prepared to accept in relation to your investment returns. So it's being prepared to experience a negative investment return while trying to achieve positive investment returns, and whether you can recover in the event of a reduction in your income or capital. Before you invest, you need to make sure that you research your investment choice to understand how it generates a return and the type of return expected, whether capital gain or income. How long you should invest to receive the expected return? Is it immediately, or will it take 1 to 2 years? The risks involved with the investment, and are you comfortable to take on these risks? What about access to cash or liquidity? So how long will it take to sell the investment and get your cash out? The cost to buy and sell. So how much will it cost to buy and sell the investment you want? And then finally, legal and tax implications of the investment. So how much tax will you need to pay on earnings, on the income, and capital gains from the investment? So as discussed earlier, you can find this information in the product disclosure statement, or PDS. And if you need help choosing the right investments, we recommend you seek professional financial advice. Now, older Australians can access their superannuation either at their preservation age and where they're retired or accessing a transition to retirement arrangement, or if they're at least 60 years old, and this allows them to access their preserved benefits when they leave a job. And finally, if you turn 65 years of age. So your date of birth will determine your applicable preservation age. Being retired from the workforce has different meanings based on your age. So if you're under 60 years of age, you can access your preserved benefits only when you reach your preservation age, have ceased gainful employment, and have no intention to become gainfully employed in the future. So ceasing gainful employment means you are not working more than 10 hours per week, And if you do require more information regarding this, please check out the Australian Taxation Office website. Now, if you are over 60 and have ceased one employment arrangement but continue in another employment arrangement, you may access all the benefits accumulated up to that time. All amounts accrued after that date will be preserved or restricted non-preserved benefits and cannot be cashed until a fresh condition of release is met. Access to super is restricted and is only available under certain conditions. So please be mindful that schemes which claim to provide ways to access preserved super outside of these release conditions are illegal and could impose penalties, including a retrospective tax being applied of 47%. So in special circumstances, part of your super benefit can be released before your preservation age, and you will need to check with your individual super fund for more details. Now, super income streams are a popular investment choice for retirees because it gives you tax advantages and helps you to manage your income and spending. Super income streams are sometimes called pensions or annuities and may be either an account-based super income stream or a non-account based income stream. Once you reach your preservation age, you can access your superannuation as an income stream, even if you do continue to work. This is known as a transition to retirement income stream and are useful if you want to cut down on your hours of work as part of your preparation for full retirement. Some people also use the tax concessions of the income from super to then salary sacrifice salary back into super, which minimizes their taxes and boosts their savings. Now, if your super fund allows it, you may be able to withdraw some or all of your super, and this is better known as a lump sum. So if you take a lump sum out of your super, the money is no longer considered to be super. And if you invest the money, so for example, you put into a term deposit, the money that you earn on those investments will not be taxed as super and may need to be declared in your tax return. So creating a financial plan is something you can accomplish yourself. What you need to do is you need to write down what you owe, so your debts, and what you own, your assets, as this will help you to identify what savings you can invest. So for your assets, we're looking at any supers you have, your home, your savings, and other investments. What about your income and expenses that you have? So what you might do here is use a budget planner, and this will help you track what money is coming in and going out. This helps you to identify or see how much you can put towards investing regularly. What about your financial goals? So how much are you going to need and how long do you have to reach it? Will depend on what you're planning to do. So if you're after that $10,000 holiday or you're wanting to reach $500,000 in your superannuation before retirement, this is going to determine what time frame you're working with. So if it's short term, it's 0 to 2 years. If it's medium, it's 3 to 5 years. And if it's long term, it's going to be for 5 years or more, but might be covering like home loans, paying off a home loan, or saving up for superannuation. So as you accumulate wealth, you may require various kinds of insurance to protect your assets. This may include home and contents. It might include insurance for you, so life insurance, income protection, business insurance, just to name a few. So insurance is among the most effective strategies to protect family wealth while alive and when you die. Estate planning records what you want done with your assets after your death and involves real property or personal property, liabilities, or debts. It can include documents such as your will, a testamentary trust as part of your will, superannuation binding nominations. So that's where the super fund, in the event of your death, must pay your superannuation benefit to your nominated beneficiary unless it would be unlawful to do so. It could include an advance healthcare directive, what you'd like done with your body, any powers of attorney that you might want to have, and finally, a power of guardianship. So giving someone the right to choose where you live and to make decisions about your medical care. So the documents you choose will depend on your situation and what you're comfortable to trust others with. So please get legal advice if you're not sure. And also remember that you do have to be over 18 and mentally competent when you draw up your estate plan. Now, A good financial advisor works with you to understand your needs, set your financial goals, and creates a plan to help you achieve them. So, anyone who gives financial advice must have an Australian Financial Services AFS license, which is given by the Australian Securities Investment Commission or ASIC, and it allows people or companies to legally carry on a financial services business, including selling, advising, or dealing in financial products. You should only deal with licensed businesses as you are better protected if things go wrong, and you will have access to free dispute resolution services. Now, before you get financial advice, you need to decide what you want to get out of it. And this will depend on your stage of life, how much money you have, and what you're trying to achieve. Once you know what you want, find an advisor who offers the right services for you. So, to assist with this, you can look for financial advisors through the Financial Planning Association, the Association of Financial Advisors. You can ask your super fund, your lender or your financial institution, or better yet, through the recommendations from other people, so word of mouth from friends. When seeking advice, you need to choose whether you want general or personal financial advice from your advisor. So, general financial advice doesn't take into account your personal situation or goals or how it might affect you personally. On the other hand, if you're after personal financial advice, it's tailored to your financial situation and goals, and it's in your best interests. It can include something simple or single issue advice, and that's where they help you with one financial issue. So, for example, it might be how much to contribute to your super or what to do if you inherit shares. If you want comprehensive financial advice, that helps you to develop a financial plan to reach your financial goals. This covers things like savings, investments, insurance, and super, and also retirement planning. Or you might want ongoing advice, and that basically involves regular monitoring and review of your financial plan and affairs. Now, with financial planning, you should receive a statement of advice or SOA. This sets out what the advisor recommends and why they think it's suitable. It's important to review this and consider how well it meets your needs and objectives. A product disclosure statement or PDS for each product they recommend, and this will describe the features of the product. And then finally, you should be getting a financial services guide or FSG, which outlines the services a planning firm can provide along with the complaint resolution procedures. Now, please remember that financial plans are a recommendation only. You must still decide um, at the end, but do not sign or agree to anything until you have read and are happy with these documents, and do not feel pressured into signing anything. The advisor will make recommendations, but it's still up to you to decide if the advice is good for you. Now, here are some things to consider when you read the advice. Does it address the reasons you sought advice? Are the recommendations relevant to you, or could it be written for anyone? Does it refer accurately to your assets, liabilities, income, and expenses? Does it compare different options and explain the advantages and disadvantages of each option? And does it clearly show all the fees you'll pay, how they're paid, and who they're paid to? Now, if you're not happy with your advisor's response, you can make a complaint through in the internal dispute resolution process. So look for information about making a complaint on your advisor's website, or ask for a copy of their financial services guide. If you're not satisfied with how your advisor has handled your complaint, you can contact the Australian Financial Complaints Authority or the Financial Advisors Professional Association. So thanks for all your questions during the first part of our webinar this afternoon. So before I pass you on to my colleague, John, there is one question that we will go through with the answer from our moderators. So the question was, I'm already on the pension, so if I take my super as a pension, will that income affect my Centrelink payment? So firstly, great question. So income streams are regular payments made from your superannuation fund or purchased using either superannuation money or savings. Different types of income streams have different effects on your assets test and income test for payments from us. So when we test your assets and income, we treat different types of income streams in different ways. So to ensure we provide information accurate to your circumstances, please call our 132300 number, And when prompted, say financial information service, and we can discuss this further. You can also find information at our www.servicesaustralia.gov.au website. And if you go to the top of the web page, find the search box and search income streams, you should find some further information there. So again, great question. So thank you once again for your questions, and please continue to post these questions as we move along. I will now pass you on to my colleague, John, who will take you through the age pension payment and working beyond age pension. Thanks a lot.
Thank you very much, Chris, and hello everyone. I'm just waiting to pop up on screen there. Where am I? Oh, there I am. So we're now going to take a deeper dive into working beyond the age pension age, and we're going to discuss choices at age pension age, as well as the reporting requirements regarding your income. As Chris touched on earlier, consider your expectations in retirement, what your lifestyle choices will be moving into the future, and the financial resources you require to fund your ventures. If you are going to be applying for the age pension, you will be assessed under the income and the assets test. Now, to determine eligibility for the age pension, Centrelink uses two tests, the age pension income test and the age pension assets test. And here's how they work briefly. The income test measures how much income you receive from all sources, including employment and investment income. If your income exceeds their certain limits, your age pension payment will be reduced. With the assets test, this assesses the value of your assets, and if your assets are above certain limits, your age pension payment will also be reduced. Now, if you or your partner work, you'll need to report any employment income you've been paid. You don't need to give us your pay slips unless we ask you for them. And if you have rental properties or own commercial premises, you are required to declare these. You're also obliged to tell us about any rental income you receive as well. When applying for the age pension, you must test your eligibility for any pensions from other countries if you think you're entitled to them also. Now, certain types of annuities are also assessed as income, so please ask us if you're unsure about these. The income earnings limits are listed in the next slide. So here we have a clearer picture. At the time of this presentation, you will see that the earning cutouts for singles and couples are listed in the right-hand column, and the left-hand column shows the first earnings concession that age pensioners can achieve if working. This means that there are components of your earnings that we do not assess, but you're obliged to report them though. Now, we assess you and your partner's income from all sources. This includes financial assets such as savings, shares, and superannuation. To work out how much income your financial assets produce, we use deeming. Now, deeming is an often misunderstood instrument the agency uses. We use it to make assumptions on your asset earnings, but we'll discuss this further in the presentation. It's important to understand how this works though. Please note we do not need any sort of valuation of the assessment for your vehicles or your contents, as contents are assessed at fire sale value. However, if you have any collectibles, you must tell us. Now, here are the current rates for the asset limits for the age pension. You'll see that the assessment is based on homeowner and relationship factors. So if any of these change at any time, you must advise Centrelink within 14 days. The asset limits change twice a year, as does the pension, so it pays to become a friend of the internet to check when these relevant changes occur and what they're going to be. If your assets exceed the threshold amount, a single pensioner will have to pay, their payment will be reduced by $3 for every $1,000 over that limit, and each member of a couple will have their pensions reduced by $1.50 each for every $1,000 over the threshold until they reach those higher cutout points. So for example, if you're receiving the age pension, but there's a change in your circumstances, such as coming into a windfall or inheritance, and this sees your assets exceed those cutout points, you will no longer be able to receive a pension. I know it's a lot of information, a lot of numbers to take in. So remember, you can watch this webinar again, or by heading to our YouTube channel, or you can view the current thresholds and cutout points on the Services Australia website. Now, as discussed, there are two tests which will determine if you're eligible for the age pension and how much you may receive. So, which test applies? Well, to determine your rate of payment, we assess your rate using both the assets and income test. We compare the two, and then the government pays you the lower of the two rates. But as your financial circumstances change, it may result in an assessment changing from the asset test to the income test or vice versa. We encourage you to look at the payment finder on the Services Australia website. Just type in payment finder in the search engine and follow those prompts to test your eligibility. Now, all financial assets, such as those listed in this slide, are the main assets you must declare in your age pension application. When applying for the age pension, please have banking statements and other financial paperwork ready for inclusion with your submission. As time goes by, you must tell us if assets are bought, sold, or cashed in, as it could affect your payment. Awareness of your obligation here is extremely important. We want you to get the right payment if you're eligible, and we also don't want you to incur debts as the result of overpayment. Now, as discussed earlier, here is an example of deeming in action. Deeming assumes that your financial investments are earning a certain rate of income, regardless of the actual amount of income they're earning. So if a person earns more than the deeming rates, we do not assess that extra income. The government encourages you, in fact, to earn as much as possible on your investments. We add a person's deemed income to their assessable income from other sources such as wages or salary and apply this to the income test. Note too here in the slide that there is a difference between the single and the current rates limits. Now, further to this, here's a more in-depth example of how a person's assets are listed and how Services Australia deems them. You will see that under the deeming rate, Brian's assessment of assets is a lot lower. While Brian actually earned $12,100 from his investments, the government only deemed $4,440 as his earnings on investments. This is beneficial to you. Now we're going to discuss the work bonus. You're eligible for the work bonus if you're over age pension age and receiving the age pension, the carer payment or disability support pension. The work bonus offsets your income by up to $300 a fortnight from your eligible employment before this income is assessed under the income test. When you're first eligible for the work bonus, you will start with a work bonus balance of $4,000. If you don't work, you'll get $300 added to your work bonus balance each fortnight until it reaches the maximum of $11,800. Now, the work bonus and the work bonus balances are used to reduce the gross income earned in the fortnight. Now, just to recap here, the work bonus balance can reach up to $11,800 per year. And as of this year, all people commencing on the age pension receive an upfront $4,000 starting credit that you can use. The wages reduce your work balance bonus first before it affects your rate of pension. And one more slide here. A quick example, Margot earns $1,000 in a fortnight. $300 of these wages earned would be discounted, so we would only assess $700 of Margot's wage for age pension purposes. And if you have any questions, please put them in the chat. Please also have a look at the work bonus webinars and VODs that we have on Services Australia website if you're watching this in a replay. One other thing to note here is that each member of a couple must be over the age pension age to get the work bonus, and they can only draw on their own work bonus balances. Okay, Money Smart. We're going to talk briefly about this. As Chris mentioned, the Financial Information Service are not financial planners and don't provide financial advice. We can, however, refer you to the moneysmart.gov.au website, as there is a wealth of information available to you. Have a look at the range of financial options, explanations, concepts, and you can gain so much information from them. It really is valuable. And remember, if you do engage a financial planner, the terminology and products they use here are explained on the website so you can understand what they're talking about. Now, we're going to move on to scam awareness. Unfortunately, scams are a growing concern in our society, and older Australians are an overrepresented target market for scammers. Scam awareness is your responsibility, and it's wise to maintain constant vigilance against it. Arm yourself with as much information as you can regarding this, not only through the Scam Watch website as listed in the slide, but there are a number of other organisations such as the ACCC and relevant state organisations who offer preventative education and information so that you're wary of tricksters, both online and door to door. Services Australia also has great information on our website. Just type in scams into the search engine to access the latest known information. Our biggest takeaway today, though, is that the government and the banks will never send you texts or emails with links attached to them. If you're unsure about this when contacted, please either hang up or don't open or click on the link and call that organisation back to check to see if it was a legitimate and bona fide contact. Now, let's just go back to your action checklist here. We'll do a little recap. Consider what your spending habits are. Will you have to change these once you're on reduced income? And what does your future look like as a result of this? Will you seek a financial planner, or remember that Centrelink can give you the information, but the decisions are ultimately up to you? Is there capacity for you, or is there a plan for your debt reduction moving into retirement years? And how long will your superannuation last you? Also, is your estate prepared, as we touched on, but it's very important. And as Chris had mentioned, don't forget to include advanced health directives in your relevant state because they should be considered because so that family members don't have to make serious medical decisions on your behalf. You can make them in advance. Also, what are your plans long term if your investments expire? Okay, moving on to concession cards. Just briefly, the pensioner concession card is available to people who receive certain Centrelink payments. The age pension is one of them. So you don't need to apply for this. Centrelink will send you one if you're eligible. The benefits of the card includes cheaper medicines under the pharmaceutical benefit scheme, bulk bill doctor visits, depending on your doctor, of course, a bigger refund for medical costs when you reach the Medicare safety net, help with hearing services such as the Hearing Services Program, and this is on the Department of Health and Aged Care website, and also discounts to redirect your mail through Australia Post should you need it. Now, your state and territory government or local council may also be able to offer more benefits, including discounts on utility bills, water and rates, discounted public transport, and of course, vehicle registrations. Healthcare cards will give you access to cheaper medicines and some discounts if you receive certain other payments from Centrelink. And it's also important to note if you are not entitled to a pension and you're over age pension age, you may be encouraged to apply for the Commonwealth Seniors Healthcare Card. You could also consider testing your eligibility for a low income healthcare card. So please refer to the website for all of these options. Now, the My Government Express Plus apps do make it simple to sign into your account, easy to view, inbox messages are available, and they're quick to access your services. There's also a digital wallet where you can store some of your government digital cards and certificates. We are continuing to add security features and improve the app for you over time. Now, like it or not, the internet and the apps are here to stay. Service Australia staff can assist you with getting these tools on your devices and learning how to access them. We can help you with this. If you need help, we have online help guides as well as videos and the Services Australia website. Now, moving into having authorised representatives, you may find it's sometimes easier for you to have someone else to speak to us on your behalf. You can ask someone to act for you with your Medicare, your Centrelink, your aged care, or child support, and you can authorise that person to speak to us, update your details, get payments for you, or all of the above. If you choose to do this, you can still conduct your business with us normally as you would, but it just means that your nominee can help you when you need them to. Now, if you need to change your authorised representative and you're worried about your safety, we may be able to help you. Speaking with one of our social workers if you are in or have left or are preparing to leave a family and domestic violence situation, you can reach out to one of us at the service centres, any service officer, or call on 132 850. I'll just repeat that, 132 850. Now, please have a look at the FIS pages on the Services Australia website. We communicate lots of helpful information as well as helpful little videos ranging numerous financial topics that will benefit yourself. We also offer a variety of channels, as you can see, that you can contact us on. Take note of these for when you need them. They are available on the website or in this webinar recording once it's been posted. And now that we have the internet, we can keep you up to date regarding any relevant changes, and you can keep across all of them from the comfort of your own home. You don't have to come into a Services Australia office to see the FIS, Financial Information Service officers, every time there's a relevant pension change, or you have a quick question or something's changed in your life and you need to know about it. Services Australia does offer digital literacy classes that you can book into in our service centres for your learning assistance if you require it. Well, that's the end of our presentation. I'd like to thank my colleague Chris for co-presenting today, and I would like to thank all of you for attending our webinar. We look forward to seeing you again at further events. The next one, I believe, is Home Equity Access.